Hello, and welcome to the latest edition of the Quarterly View from Glassy Mountain Advisors. I'm Jordan Smythe, the founder of Glassy Mountain Advisors, and it's good to have you here for this presentation. I'm going to begin by providing an overview of the stock market's performance in 2022 and then provide our outlook and some investment implications. In summary, we are glad to ring in 2023, leave 2022 behind, and move into what will hopefully be a better year in the markets. The U.S. Federal Reserve's actions to slow the economy and tame inflation appear to be working, but the economy is still relatively strong by some measures, particularly employment. While the United States may experience a recession later this year or in 2024, we believe any recession is likely to be brief and mild. The truth is that nobody knows exactly what 2023 will bring in economic news and the markets. While we can make predictions for what may happen in the short term, we make investments in expectation of good long-term results, even with rough stretches in the market along the way. We are optimistic that the U.S. and foreign economies will expand over time and markets will provide attractive returns for patient and disciplined investors with sound strategies, even as the stock market likely remains volatile this year. Stocks in the S&P 500 index rebounded in the fourth quarter of 2022, returning 7.6% with dividends included, but still leaving the index down 18.1% for the year, its worst performance since 2008. The NASDAQ index plummeted nearly 33% as investors soured on technology stocks, which had led gains for several years. Bonds had their worst year since records began. The Bloomberg Barclays U.S. Aggregate Bond Index dropped 13% for the year, even after gaining 1.9% in the fourth quarter. The yield on the 10-year Treasury remained steady during the quarter, at about 3.9%, up sharply from 1.5% at the beginning of the year. Inflation has been the main focus for investors, who watched closely as prices rose during the year at the fastest pace in 40 years. Extraordinary events, including supply chain issues related to the COVID-19 pandemic, increasing rents due to pandemic-related migration, and Russia's invasion of Ukraine, were among the primary causes of inflation. While these and other issues constrain supply, consumer demand remains strong, partly because of low unemployment and increasing wages. The annual core inflation rate peaked at 6.6% in September before declining in November to 6%, still high by historical standards. In response to rising inflation, the Fed hiked its federal funds rate 7 times over the course of the year for a total increase of 4.25%, the largest since 1980. The most recent rate hike of 0.5% in December was less than the 0.75% rise in each of the previous 4 Fed actions, a more moderate move reflecting data showing that inflation had started to wane. Some analysts had hoped that easing inflation might lead to rate cuts by the Fed in 2023, but Fed officials emphasized their determination to raise rates further, if necessary, and not make cuts until inflation is clearly under control. Employment data remains strong, but is showing some signs of easing as employers see the possibility of an economic slowdown. After averaging 562,000 new jobs each month in 2021, employers added an average of 375,000 per month in 2022 and 223,000 in December. The unemployment rate dropped to 3.5% in December and has been in a narrow range of 3.5% to 3.7% since March. Job openings remained steady at just over 10 million, and wages rose 4.6% over the 12 months through December, a healthy increase but a slight decline from November and lower than inflation over that period. This employment data is evidence of a job market that is cooling slightly but is still strong and a threat to the Fed's efforts to reduce inflation by slowing the economy. Analysts lowered corporate earnings forecasts throughout the quarter and currently expect a roughly 4% decline in profits for the fourth quarter compared to a year earlier, which would mark the first drop since the third quarter of 2020. Consumer spending growth has moderated due to concerns about a potential recession in 2023, though savings that remain above historical levels should provide some cushion. As we enter the new year, we anticipate more market volatility due to uncertainty about inflation, the Fed's move to tame it, and the potential for a recession. We do not expect another downturn like we saw in 2022, but stock returns may be modest until the economic picture becomes clearer. The Fed is likely to raise rates further, though probably at a slower pace than in 2022. Chair Powell and his colleagues will continue to wrestle with balancing actions to slow economic growth and reduce inflation with their desire to avoid sending the economy into recession. However, the Fed has clearly stated that its top priority is to bring inflation to a level closer to its long-term target of 2% annually, even if doing so leads to recession. The Fed wants to avoid raising rates too slowly or too modestly, which could boost consumer and business confidence and cause inflation to stay high. In a good sign for the Fed in its efforts, inflation expectations have dropped recently, as shown in this chart. Rents also appear to be falling, though the impact will not affect inflation numbers until more existing leases renew over the next year. We continue to monitor foreign matters, including the war in Ukraine and rising COVID-19 cases in China that are hindering the global economy. The Ukraine war does not have a clear outcome, but mild winter weather so far has reduced natural gas prices, mitigating the potential negative economic and humanitarian impact of Russia's curtailment of gas shipments to Europe. COVID-19 outbreaks in China after an easing of lockdown restrictions threaten to constrain the economy there and impact supply chains and demand for imported goods from other countries dependent on Chinese consumption. Global supply chains have improved significantly in recent months, but there is still limited availability of some materials and goods. As earnings forecasts have declined and the S&P 500 index has risen over the past several months, the forward price-to-earnings ratio on the index has increased to 16.5 times, up from 15.3 times at the end of the third quarter. The price-earnings ratio is still below the average for the past 5 and 10 years. As always, we are monitoring our investments closely and are looking for opportunities to invest in securities that are now attractively priced and offer the potential for robust long-term returns. The rise in interest rates has increased the appeal of bonds, particularly higher quality government and corporate bonds, which are an important component of our income allocations. Good riddance to 2022, welcome 2023, and here's the better times ahead. We are optimistic that those better times are coming this year, and we are also ready to seize opportunities to make good long-term investments as we wait for the market to improve. Thank you for taking the time to join us. We hope you enjoyed this presentation. We welcome your questions, comments, or suggestions, and we hope you stay safe and healthy. Take care.